Welcome to Capsim debriefing presentation. The following video will first summarize the results in round 2 of Capsim simulation, then discuss our team's strategy and decisions, then assess the overall performance of our company in the competitive sensor market. In the final part of this video is our team's reflection on the choices and decisions that we made in round 2, as well as our vision towards future rounds. Before detailed analysis of our company's performance in round 2, we will first summarize the final results for this round. In terms of profit, our company has made a profit of $4.9 million on top of $147.9 million of sales revenue. Our sales figure is the highest in the industry, but return on sales of 3.3% is the lowest compared to other companies in the market. In terms of contribution margin, the weighted average contribution margin of our products is 30.1%, which is nearly the same as competitors. In terms of financial position, we have settled emergency loans from the previous year and ended up with a cash position of $7.2 million. Our leverage ratio of 1.8 is lowest in the industry, which means we are less exposed to interest rate risks. In terms of inventory, we don't have stock out as we did in the first year. In fact, 6 of our products have only small units of inventory in hand compared to units of sales, except for 2 products, which proves our sales forecast to be approximately accurate for these 6 products. In terms of stock price, although our earnings per share and return on equity is among the lowest in the market, our stock price has actually increased by $5 to $35.08 per share. And that is the overall performance of our company in round 2. In the next part of this video, we will discuss the strategy that our company has chosen to follow. In the first round of the simulation, our team decided to pursue a broad differentiator strategy. This changes as we progress on to second round, when we pursue a broad differentiator mixed with broad cost leader strategy. In particular, in the first round, we focused on high technology segments only, which are high-end performance and size. We invested in R&D to maintain high product quality so that we can charge high prices on our products and meet customer needs. We also invested heavily in promotion and sales budget to increase awareness and accessibility so that we can capture as much market share, market demand as possible. And the last but the most important point of the strategy that we followed in the first round is to introduce 3 new products in each of the 3 high technology segments. We do this because thereby we can expand production and sales to capture as large market share as possible, while still being able to improve and maintain good quality of our products. This method also helps to take advantage of the investments in sales budget, which is shared within each segment. And that was our strategy from round 1. However, our company's performance in round 1 wasn't very impressive, and from the results, we found some drawbacks of this strategy. Therefore, we had to make some changes to our strategy in round 2. We found out that even though we did not focus on traditional and low-end products, these 2 had made high profits and were going to make more profits in the upcoming rounds. We also found that in order to fund big investments in high-tech products, we needed the reliable profits from low-end and traditional segments. Therefore, we revised our strategy towards a mix between broad differentiator and broad cost leader. In particular, we continue to improve the quality of high-tech products, which are ADAM, AFT, agape. But for the newly introduced products, which we named ADAMs, AFTs, and agapes, we plan to reduce the cost by investing in automation. We will do the same with Able and Acre, which is the broadcast part of our strategy. Additionally, we have sold some capacity in Able and Acre from round 1, which caused stockouts and loss of sales. Therefore, from round 2, we have to expand the production of these two products in order to increase sales and make bigger profits. So that is our VHL company's strategy for round 2. Then, after revising the strategy, we made decisions accordingly, and now we will analyze the details the results to see if our company is on the right track or not. First of all, our company has achieved our goal of leading the industry in sales revenue. We achieved this goal by introducing in round 2 3 new products, which are called ADAMs, AFTs, and agapes. These 3 products helps to enhance our market share in their primary segments. At the end of round 2, we have the largest market share in performance and size segments and the second largest market share in high-end. We only lose market share in high-end to a competitor which focuses completely on high-end segment. On the other hand, our Able and Acre products, although are placed at a very best position in the segment and are designed and priced to satisfy their the need of customers. Surprisingly, Able and Acre didn't reach a good market share in round 2. Able only captures 15% of traditional segment and Acre only 11.1% of low end. This could have resulted from insufficient investments in sales and promotion budgets for these 2 product lines. And secondly, the contribution margin of our products varied between products. For Able and Acre, contribution margin is considerably high, which was expected because we invested in automation for these 2 products to reduce labor cost, and also the material cost for these 2 products are much lower than high-tech products. For ADAM and agape, contribution margin is 37 and 34% respectively, which is higher than the industry average. This is very good because high-tech products are making good profits in early rounds. Then it's going to be better and better in later rounds because of these segments' high growth rates. The high profitability of ADAM and agape results from high selling price of ADAM and low material cost of agape. On the other hand, contribution margin of AFT is only 26%. This is because we designed AFT to meet customers' need for reliability, thus increasing the material cost. For newly introduced products, contribution margin are much lower, which is 25% for ADAMs, 15% for AFTs, and 18% for agapes. This is because the products came out during the year of round 2, so we didn't have a chance to revise the products. Thirdly, the inventory in hand of our products are pretty much at a healthy level. For Acre, ADAM, AFT, agape, ADAMs, and AFTs, the ending inventory is very small compared to unit sales, especially for Acre, AFT, and ADAMs and AFTs. The ending inventory is only less than a month of annual sales. This proves the accuracy of our sales forecast for these products. For Able, on the other hand, ending inventory is 529 units compared to 1,330 units sold during the year. Although this is much less than the first round's ending inventory, the figure is still very high and greatly increases inventory carrying costs. Therefore, we need to make more realistic forecasts for Able. The same applies for Agape's. While we have 133 units in hand at the end of round 2, compared to only 224 units sold in the year. Although Agape's came out later in the year, making a loss of a couple of months of sales, so sales forecast must have included that fact for better results. In total, our return on sales is 3.3%, and net margin is 16.5 million or 11.2% of total sales. Largest contributors are Able with 6 million margin and Acre with 5.5 million margin. 4 high-tech products of Adam, Aft, Agape, and Adams are making sound profit margin of between $1 and $1.5 million, while Afts and Agapes are making losses. The loss on Afts are expected because we didn't revise the product while its material cost is extremely high. However, the bigger loss of $278,000 on Agapes is unexpected. This could have resulted from our unrealistic sales forecast for this product, but this requires further investigation. Next, our cash position has greatly increased from round 1. As mentioned before, we have settled the 7 million emergency loan made in the last year. Then we make further investments in R&D and buy capacity for production, and all this we did with only cash flows from operating activities. We even ended up with 7.2 million in cash, but we chose not to buy back shares or pay dividends because we expected that stock price is not going to be a problem for our company in the near future. After studying the results of round 2, we assessed our company's performance and tried to find out weak areas that needed improvement. First, as mentioned earlier, the ending inventory of Able is very high, which indicates unrealistic sales forecast for this product. Keeping more inventory means higher carrying costs, which we don't want because our company is pursuing a cost leader strategy for traditional segment. Therefore, we have to keep unnecessary costs at a minimal level. Second, our company's retained earning is relatively high compared to our equity and debts, which is an advantage because it allows us to acquire more finance from equity and debt. This advantage we did not take in round 2 because we didn't make any financing activity. Therefore, we could have raised more funds and invest more aggressively in automation and sales automation and sales and promotion budget. For future rounds, we will address these 2 issues by performing better sales forecasts based on both calculations and situation analysis, and adopt a more aggressive strategy to grow with all the excess funding we have access to. Thank you for listening.